Welcome to Bendigo Bank's monthly market update with our latest opinions and predictions on global markets and the domestic economy. For November, we'll have a look at the latest inflation numbers and what they mean for official interest rates, offshore factors including trade and tariffs, and the ongoing influence that AI is having on stock markets and the growth outlook. The third quarter inflation numbers released last week were a material upside surprise and have pushed back the next RBA rate cut by around 6 months, probably to May next year at the earliest. The headline consumer price index was fully expected to rise due to the end of electricity subsidies in some states, but the jump in core inflation from an upwardly revised 0.7% to 1% in the third quarter was a much bigger increase than we and the RBA had expected, which was central to yesterday's RBA rates on hold decision and associated comments and press releases. The latest market curve still shows an expectation of lower rates ahead, but the latest inflation numbers were a setback, with broad-based price pressures across housing costs, market services, and grocery inflation. So, unlike the US Federal Reserve, the Bank of Canada, and the Reserve Bank of New Zealand, who all cut their rates in October, the RBA will now need to see more data before being in a position to follow suit. It's still very likely that we get another cut to 3.35%, taking us 1% below last year's peak. But the case for a deeper easing cycle is now less convincing, as the chart shows, partly due to the uncertain outlook for inflation, but also due to some promising signs, such as the recent pickup in household consumption, some improvements in business conditions, and record highs for property values and stock markets. The global backdrop is still highly complex and challenging, but some of the more extreme risks from overseas via tariffs have receded compared to 3 to 6 months ago. And the US-China trade relationship, after some setbacks last month, now appear to be in a lasting truce, while the latest economic data from our major trading partners in Asia continues to show resilience. The US aren't getting any official data as their government shutdown continues into its second month, but labour markets in the US do appear to be at risk, hence the need for their recent rate cut below 4%. Similarly here, the most compelling argument for at least one more RBA rate cut in 2026 is recent weaker jobs data, with the unemployment rate rising to 4.5% in September, its highest level since 2021, and the risk of this trend continuing over the next 12 to 18 months, as discussed here and on our Business Insights website for some time. Interestingly, the updated RBA forecasts released yesterday still only predict unemployment peaking at 4.4%. So the next few months' jobs numbers will be important to see if the RBA are right in their assumption that labour markets will remain relatively tight. Financial markets continue to take a very optimistic view on the short to medium-term impact of AI and other emerging technologies on business investment and stock valuations, with record highs for stock market indices in a wide range of locations. Nvidia was the first stock ever to reach a market cap value of US $4 trillion in July, and then a few days ago became the first stock to be valued at $5 trillion. This remarkable path reflects the recent AI investment boom. But the big question ahead is, what will the AI output and productivity boom look like? In Australia, GDP growth has picked up in 2025, but the latest RBA forecasts for growth in 26 and 27 are relatively modest. Private demand is expected to increasingly take the reins of growth from public spending next year, but the interplay between AI, productivity, and output will be a key driver for the path ahead. And that's the market update from Bendigo Bank.